Hello and welcome to this live session on the economic outlook for India. Joining me now is Mr. Prasenjit Basu, Chief Economist at ICICI Securities. Welcome, Mr. Basu.
Thank you.
Mr. Basu, hi, sir. How are you doing?
Fine, thank you.
Mr. Basu, the Ukraine invasion, the Fed tightening, new outbreak of COVID in China, they are threatening the expected rebound that we thought about would happen very soon. What has really changed in the last few weeks since we last spoke, now that the rating agencies have started revising growth estimates downward for global economies, including India? So would you also be revisiting your estimates for GDP as far as the India is concerned?
Well, first of all, let's look at the global situation. Of course, we're now, as of today, we're almost a month into the Russo-Ukrainian war, and there's no sign of the war ending anytime soon. It'll probably go on another month or so, at least. And as a result, we've got a big spike in oil prices around the world. Russia is the second or third largest producer of crude oil in the world, the largest or the second largest producer of gas, and certainly the second largest exporter of oil and gas in the world. And so the absence of the second largest exporter has had a huge impact on global markets for crude oil, and of course also Russia, as I pointed out in last month's call, Russia is the world's largest exporter of wheat. Ukraine is the fifth largest exporter of wheat. So we've seen a huge 40% spike in global wheat prices, and of course there's a slew of other important minerals that Russia is an important producer of, including palladium. It's a big producer of diamonds, platinum, and nickel. So these are all crucial inputs into global industry, and the supply shortages there will have a big impact on the world economy. Now, I think it's also important to understand that supply disruptions of this sort we saw last year as well. Last year, the supply disruptions were caused by COVID, and typically the interesting consequence of COVID-related disruptions, and this year the war-related disruptions, is that it generates an additional demand for international trade. So the economies that are less affected by that particular issue have an opportunity to fill the gaps created by the absence of certain products. And so I think for India, there's an interesting opportunity here, because India is the second largest producer of steel and aluminum in the world. Russia is the third biggest producer of both steel and aluminum. And Russia is a significant exporter of those. But Russia imports some of the alumina required for aluminum from Australia. And Australia has curtailed shipments. So there clearly will be a negative impact on Russia's aluminum production and export ability. And that creates an opportunity for India to fill the gap. Similarly with steel. Now, with regard to wheat, India typically is not a significant wheat exporter. In the current fiscal year, which is about to end, India has exported just over about $1.5 billion at most, is likely to export about $1.5 billion worth of wheat. But there's a lot of surplus wheat in the FCI godowns, and that stockpile now can be exported, because the global price of wheat, having risen by nearly 40%, is now quite a bit higher than the MSP for wheat. And as we know from the farm reform debate a year ago, the MSP is actually quite high. The MSP that is paid out in Punjab, Haryana, Western UP is typically quite a bit higher than prices that prevail in many other parts of India for wheat. So if global prices are ruling well above even the MSP, there is an opportunity for a lot of exports. In the year ahead, we could see 10 to 12 million tons of wheat exported from India. Already, deals are being struck with Egypt, China, Turkey, a few others, to export India's wheat. Of course, it's important in these opportunities to have some quality control so that it doesn't become a one-off, and you can actually see repeat sales as well. Once you have a customer, the customer should want to come back. So some quality control will be essential. But if what is clear is that in the year ahead, there is actually going to be a lot of opportunity for India to fill gaps. And last year, in the calendar year 2021, India was the world's fastest growing exporter of goods. India's exports of goods increased 41.6% in calendar year 2021. So far, the first 2 months of this year have been very good. And the evidence is that March has been another good month for merchandise exports. And so we're seeing another year of very strong export growth. And that should continue as we go forward. So I will take a look at my forecasts for growth. But I think India's outlook remains pretty robust. And in fact, with the disruptions in China, what is interesting is that China, this is essentially the second wave of COVID in China. The first wave was just in the first quarter of 2020. Before the rest of the world got COVID, China, of course, got COVID. I mean, it was originally called the Wuhan coronavirus. It emerged in Wuhan, the capital of Hubei province in China. And but by the second half of March 2020, China had contained the impact in China itself. And then it spread around the rest of the world. And since then, for pretty much the next 24 months, China has contained the impact of COVID on its own territory. Now, if you look at the last 1 week, was the first time since the middle of March 2020 that China had more COVID cases than India. China had about 15,500, India had about 14,700. Now, 15,000 in a week is still a very small number. China, I think, is number 46 in the world in terms of last week's total of COVID cases. India is 47 among countries. So it is not yet a situation that is truly alarming in China. But as we know, China has had a lot of experience with COVID. They have, not just COVID, with various forms of coronavirus, starting with the SARS epidemic in 2003. Then there were at least a couple of bird flu epidemics, and there was swine fever, mainly in the pig population, but it spread, occasionally spread to humans. So China has a very has a lot of experience dealing with coronaviruses, and it is very aggressive in dealing with them. So that aggressive action that they are taking currently is having a negative impact on a number of industrial bases, a number of manufacturing bases in China, because the current relatively mild COVID wave in China is focused on a couple of areas. One is Guangdong province, and particularly Shenzhen, which is the manufacturing hub of the sort of new manufacturing hub of the last 20 years. And the other province that has locked down is Jilin province in the northeast of China. And Jilin is the old industrial hub. It's the hub that existed from the 1930s to 2000 and is now considered part of the Rust Belt. So it has steel, heavy industry, automobiles. So the Jilin province's capital, Changchun, is used to be called the Detroit. We could call it the Sri Perumbudur of China. It is the auto manufacturing hub, or perhaps the Pune of China. Anyway, the Detroit of China, the car manufacturing hub. So those two important industrial hubs in China have been affected most initially, and that basically means that it will accelerate global manufacturers' quest to find alternatives to China. So the so-called China Plus One strategy will be accelerated now that you see these sorts of lockdowns occurring in key industrial hubs in China. There'll be a shift. And so we've seen, of course, that Foxconn and Westron and Pegatron, the three main suppliers to Apple, have all committed to and started manufacturing operations in India. And that will pick up some more momentum. The fact that Jilin is hit means that there's an opportunity for India to fill a gap that China would normally fill in the world markets for old industrial products, steel, aluminum, etc. So, if anything, there is here an opportunity for India to really take up the slack in the world economy created by the problems in Russia, Ukraine, and now China. Now, that said, I will emphasize that global growth is likely to be slower than expected at the start of the year. For instance, the Fed, the FOMC members' forecasts for real GDP growth in China in 2022 was 4%. In December last year. 3 months ago, they were forecasting 4% growth. Now they're forecasting 2.8% growth. And part of that is simply a reflection of the fact that the FOMC members completely underestimated inflation in the US. If you remember, when I gave this talk last month, I pointed this out, that the FOMC members have been way behind the curve on inflation. And inflation is going to keep surprising on the upside, which means that the Fed is going to have to tighten far more than the FOMC has been projecting thus far. And of course, at the meeting last week, the FOMC members now expect that by the end of this year, the policy rate, the Fed funds rate, will be at 1.875%, which basically means at least 6 more 25 basis point hikes, one at every meeting through the course of this year. Now, I think it is quite possible that if inflation edges even higher, if it goes above, say, 8% in the next month, then they might have to do 50 basis points in the next meeting, simply to jerk the system and to slow down the inflationary surge, as well as the fact that wage expectations are beginning to rise as well in the US. So what I pointed out last month also is that if you look at average broad money growth in the US, broad money supply, in the period between March 2020 and January 2022, that is the so-called COVID period, US broad money has grown at an average monthly pace of 18.7% year on year.
Right.
That compares to a 60-year average pace of 6.8% in the period preceding. So 6.8% was the average growth. And during this two-year period, we've had growth of 18.7%. It's not even on the page. If you draw a chart, it goes off the chart. So the old chart was down here, maximum was 10% some months. Now it's gone to 25, 27. So it's it is completely out of line with what is normal. And so the Fed is now having to aggressively roll back that huge monetary expansion that occurred over the last 2 years. And that is going to be quite negative, I think, for the world economy, and it will slow the US economy as well. Now, a number of others, the Bank of England has raised rates as well.
Right.
But the UK economy is relatively small. It doesn't matter so much. The ECB is also talking about pulling back on its ultra loose monetary policy. Yeah. So we are seeing a global move towards higher interest rates and tighter monetary policy, which means that we're going to see slower global growth this year. Now, last year was only the second year since 2010 in which global trade volumes grew more than 1.5 times global GDP growth. Now, that was the norm. Before 2010, if you look at the period from 1945 to 2010, that was the norm. Every year except in a global recession year, global trade grew 1.5 to 2.5 times as fast as global GDP.
Okay.
Then from 2011, especially 2012 onwards, this stopped. And I have my explanation is that China basically had gone on an investment boom, huge investment boom, which began to bust after 2012. They slowed down. So China was a big source of additional global trade, and it has stopped. It has slowed down its ability to keep investing has deteriorated over time, and that has slowed the world economy and slowed global trade in particular. So people talk about Trump being the reason for deglobalization, but deglobalization really began 10 years ago with this phenomenon. And 2017 was the 1 year in which global trade grew 1.5 times as fast as global GDP. And last year, 2021, global trade grew twice as fast as global GDP. This year, I expect that global trade will again grow 2, maybe 2.5 times as fast as global GDP, because these additional disruptions to important suppliers of minerals and raw materials will create an opportunity for others to get in. Of course, it'll also create some problems for the world. I mean, major problem is that high food prices will have a deeply negative impact on food importing parts of the world. So some parts of Africa and West Asia, what is called the Middle East, are significant importers of food.
Yeah.
But of course, oil exporting countries in the Middle East will be in good shape. I never like to call it Middle East because for us it's West. The Middle East is Middle West for us. But anyway, Middle East is a British concept or an American concept. Anyway, so in West Asia, the oil producing countries and oil exporters have a natural hedge. They'll import more wheat, they'll import more, perhaps more rice, more of other things, and pay a higher price for it. But they'll also be earning substantially higher profits from their exports of oil. But it's countries like Yemen and Sudan, which don't have really significant, South Sudan more than Sudan, those countries that don't have substantial oil exports, Syria, those are the ones that will suffer quite a bit more from the disruptions to wheat. And as a result, we'll see some, I think, global GDP growth this year is going to be quite a bit slower than we had last year. So last year we had estimated growth of nearly 6% in global GDP. This year, I think it'll be more like 3.5 to 4% global GDP growth, a much more normal, in fact, slightly below normal year for global GDP growth. But I'd say the global trade volumes probably still managed to grow 7 to 9% this year. So India, for instance, I think will continue to see its share of global exports rise as it did last year. And so the export sector is going to be a source of strength. Now, that is interesting also because India typically is seen as a sufferer from high oil prices. Because clearly, when oil prices are high, India automatically sees its oil import bill go up. Now, there are some mitigating factors here. Of course, there's some cheap oil available from Russia, etc. But frankly, there are only 3 Indian refineries that can process and refine the heavy crudes from Russia. Russia doesn't produce too many lighter crudes, and so it's only a partial mitigant. I don't think it's a full mitigant. But at the same time, interestingly, India is the largest export market for American crude oil exports. Single largest. Last year, India became the largest export market for American crude oil exports. And so America is going to be keen to continue to supply that. And India exports a lot of refined product to the United States. And our refined product exports are about 1/3 the value of crude imports. So it isn't completely a negative picture when oil prices go up. India does export more of refined product as well. But I think the other factor is that the countries of West Asia, like UAE, is the 3rd largest export market for India. And we've just signed an FTA, a free trade agreement with the UAE this month. That will, that coupled with the fact that you get a big surge in incomes in the UAE as a consequence of higher oil prices, not just UAE, Saudi Arabia, the GCC countries as a whole, they'll all see a big increase in income. That'll suck in more imports. And India, because of proximity, is usually a big supplier of a lot of exports into that region. So I'd say the external balances, my current account deficit forecast for FY23 was actually 1.5% of GDP. Many people are now pushing that up to 3% of GDP. I have cut my forecast to 1% of GDP because oil import prices will go up in the short term, particularly in the current quarter, in the next quarter. But we'll also see a big increase in exports, especially to the oil exporting countries themselves, but also to the rest of the world, because India is the single country that will be able to supply the precise products that are disrupted, except for oil, of course. Apart from oil, all the other products. So if you look at US imports of oil from Russia, right? The US imported about 245,000 barrels per day of oil and oil equivalent from Russia last year. But the composition details are not there. But if you look at the year 2020, US imports from Russia of crude were only 73,000 barrels per day. About 200,000 barrels per day was the total. So the rest of it was refined petroleum product. So the ban that the US has put on imports from Russia actually is a classic opportunity for the Indian refiners. So Reliance and Nayara Energy, what used to be SR Oil, I mean, those two are going to be seeing a huge increase in US demand for their refinery product. And so I see that near term, there are some negatives for India, but in the medium term, I think this situation is actually quite positive, and India will be a significant winner in the year ahead from the export opportunities arising from the disruptions that we're now seeing, especially the Russia-Ukraine disruptions, but also the short-term disruptions in China. I mean, we can't predict precisely how long the China disruptions will last.
Okay.
I don't think the second wave is contained in China yet, nor has it really run away. It's not, it's nowhere near, for instance, what South Korea is facing. South Korea is seeing 350 to 400,000 cases a day, new cases a day.
Right.
China is seeing about 2,300. I mean, it's just not in the same ballpark. And Vietnam is seeing a huge increase. But in some senses, China's situation is akin right now to what Vietnam's was about 6 months ago, when, after 2 years of very effective containment, Vietnam suddenly saw a small spike, and then it became a very serious spike. That hasn't gone away yet. Vietnam is number 3 in the world right now in terms of the weekly count of COVID cases. Number 2, by the way, is Germany. So South Korea, Germany, and Vietnam are the top 3 in the world right now. So, and now again, Vietnam is another country that is typically a beneficiary of disruptions to China, because Vietnam also has a very dynamic export sector,
right.
that in some ways is a substitute for India. I mean, India competes in many of the same products, but not all. Vietnam doesn't compete in everything that India does, but in some of them. So with Vietnam, China, both disrupted, there is an opportunity for India to really take up the slack.
Now that, Mr. Basu, you are expecting the US Fed to go for aggressive rate hikes, and you're also expecting that they might increase in the next meeting their Fed rates by 50 basis points. So what will be the stand of RBI? Do you still expect RBI to wait and watch over the situation first and then go for rate hikes? Or do you expect them to really act promptly and go for a rate hike, as inflation is a big concern for India if it spikes? Till now, they have been able to manage it well.
So if you look at inflation, CPI inflation has been slightly above 6% in the last 2 months. Latest month was just below 6.1%. Previous month was just over 6.0%. So we've had 2 consecutive months of inflation above the RBI's target range. The target range is 2 to 6%, and it is above that range right now. I think it will stay at or slightly above 6% for another couple of months in March and April.
Okay.
Partly, the slightly mitigating factor here is that you had quite high inflation last year as well. Okay. Last year, the biggest boost to inflation was because of supply disruptions during the second wave, which was April to July. So I was expecting that this year, April to July will be the period in which inflation in India moderates because of the high base from last year, and then moderates quite a bit further later in the year. But right now, we have a slightly different situation, and that is that Brent is surging. Yesterday, of course, in addition to everything else, there was a bombing by the Houthis of Saudi Aramco's facilities in Saudi Arabia, and that could disrupt Saudi Arabia's oil supplies as well. I think that it is extremely likely that the Iran nuclear deal will be done in the next few days. Because if you look at Iran's nuclear situation, as of January, they already had, by expert estimates, Iran had enough fissile material, that is uranium-235, concentrated to 90% level to produce one nuclear bomb. So you need 45 kgs to produce one nuclear bomb.
Okay.
And by January this year, Iran already had that. Estimates are that by this point, Iran has enough fissile material for 2 nuclear bombs. And in another month or two, they'll have enough for 3. Now, they do not have the known ability, technological ability, to produce a warhead or a delivery vehicle that can deliver the warhead to a target. So these 2 things are required to be tested. Unless a country actually tests this ability, they cannot say that they actually have a nuclear weapon. So the point is that Iran is probably 6 months away from having a deliverable nuclear bomb to be tested.
Okay.
They currently have enough fissile material for at least 1 or perhaps 2 nuclear bombs. They have fissile material, but not the technology, not the full panoply. So that makes it essential to conclude a deal with Iran quickly. But there are a few problems. Saudi Arabia, UAE, and Israel are strongly opposed to Iran acquiring a nuclear bomb. No question. They are strongly opposed to that.
Right.
They're also quite strongly opposed to the easing of all the sanctions that will happen as a result of the revival of the Iran nuclear deal. And so it is a delicate situation for the US. Interestingly, the US has withdrawn the designation of the Houthis in Yemen. The rebels, the Iran-backed rebels in Yemen, called the Houthis, were designated a terrorist organization by the Trump administration. The Biden administration has withdrawn that designation. So clearly, the Biden administration is wooing Iran.
Okay.
And the Saudis and the UAE are extremely unhappy. So there is talk. I mean, the Saudis have been openly talking about using the Chinese renminbi or Chinese yuan as the currency in which they denominate some of their oil trades. And that is potentially, actually, in the long term, that is an earthquake in the global financial system, because the US dollar is the world's reserve currency.
Right.
Has been, I'd say the US dollar has been the world's reserve currency since pound sterling fell away in 1925-26. So it's almost a century during which the US dollar has been the world's reserve currency, and especially since the Second World War. If other countries begin to denominate important trade in currencies other than the dollar, that undermines the predominance of the dollar. And in the long term, that would be a very, very grave step. So far, we've had no serious response from the Americans. The Americans are focused completely on Russia and Ukraine.
Yes.
They're missing some of this stuff. So there's even talk, there was some talk of India importing from Russia and using the Chinese renminbi as the intermediary currency. I think it's a terrible idea. I hope that's not being implemented, because frankly, if India is looking for an intermediary currency that is stable, India should look to the Hong Kong dollar. The Hong Kong dollar is a convertible currency, and it is pegged to the US dollar. So if Russia is unhappy about using the US dollar, we suggest to them that you can use the Hong Kong dollar as the reference currency instead. Hong Kong is, of course, under, is slowly being, its autonomy is being eroded away by China, but on monetary policy, Hong Kong still has autonomy. and therefore I think that would make much more sense. If you want to use another currency, use the Hong Kong dollar. I would say use the yen, but the Japanese have come out very strongly in favor of sanctions against Russia, so that might not be good. So really the only option is to use the Hong Kong dollar if you use a reference currency, and that would be the way to go. But I think we have a small tremor in global financial markets with increasing talk of people using currencies other than the dollar. Now, part of why they might want to do that also is that you will notice that the United States froze Russia's foreign reserves. About half of Russia's foreign reserves were held in US dollars. A lot of the rest is held in euro. But the US portion has been frozen. Now, these are extreme actions. This is a form of default, actually. When US is actually defaulting by doing this, but of course, nobody is calling it out in that sense. But what it does is that it makes other countries wary. And so Saudi Arabia is now wary of its very rigid peg to the US dollar. Saudi Arabia has never had a currency that is unpegged to the US dollar. It's always been a tight peg to the US dollar. So have all the other GCC countries, with the exception of Kuwait, which now runs its currency against a basket that is dominated by the dollar. So similar to the Singapore system in Kuwait, but the others have a tight peg to the dollar. So if they begin to feel that a more hostile US might sort of take away their dollar holdings or make them inaccessible at some point in the future, then they might want to start diversifying away from dollars as well. And so these are initially just rumblings, but they are somewhat worrisome. I mean, especially for a country like India that is fundamentally, strategically friendly to the United States, but also from a defense standpoint in particular, very dependent on Russia, and I think the government of India has taken absolutely the right stand by staying neutral in this, not voting against Russia at the UN Security Council or in the UN General Assembly, because Russia was a steadfast friend to India in very important past conflicts, and that is a relationship that India wants to continue to nurture. But it's a difficult balancing act. We've already had 2 members of the Quad visit us. We've had Prime Minister Kishida of Japan visit last weekend, and now Australia. We're about to conclude a free trade agreement with Australia. So 2 members of the Quad, 2 close friends of India, have visited. The 4th member of Quad is still a bit unhappy, clearly, about India's stand with regard to Russia. But it is a stand that India is taking in its own national interests, and it has every right to do that, just as one would have hoped that Germany would have acted in its own self-interest, because Germany gets all its gas from Russia. And the interesting thing is the European Union is currently paying Russia 400 million euros a day for gas supplies. Gas supplies are still continuing through all the pipelines except Nord Stream 2, which hadn't come into operation. So all the other pipelines are functioning. They're supplying oil, including some of the pipelines that go through Ukraine. So Ukraine is getting some revenues as well, the transit fees, and that continues despite the war. But India is coming under some pressure for even buying small quantities of crude at cheaper rates from Russia.
Talking about crude prices only, they have been on the higher side. Raw material input costs for the companies have been on a higher side. We have seen some few of the sectors going for aggressive product price hike also. So, what is expected of the earning this time, or the Q4 earnings for the corporate India? Do you expect the margins to be under pressure for companies and earnings not as positive as were expected earlier?
Well, I think if you look at the oil marketing companies, they are generally passing on a lot of this oil price increase to consumers. We've seen big spikes in diesel, LPG, petrol prices in recent days, and so I don't think they'll be too badly affected. ONGC will probably see a big surge in their profits. Now, I think the important thing is that, to my mind, the oil price spike that we've seen in the last couple of months is likely to be a fairly short-term phenomenon, partly because the disruption from Russia is going to be about 3 million barrels per day. Russia exports about 5 to 5.5 million barrels per day in normal times. It is, of course, continuing to export gas to its major markets in Europe. 70% of gas exports go to Europe. They mostly are continuing. Germany is trying to diversify. It's trying to set up some terminals to receive Qatari gas, etc. But that'll happen a year from now. It's not as if they can do it immediately. So Russia's still seeing that. But of the crude oil exports, I'd say about 3 million barrels per day of Russian crude oil is probably off the market right now and likely to stay off for as long as the war lasts, and probably for many months after the war ends. So you basically need that to be replaced. The reason why oil prices moderated below $100 a barrel 7 to 10 days ago is partly because it became clear that we were likely to see Iran come back to the market quite soon. And we were likely to be able to see Saudi and UAE crude exports pick up because they have substantial surplus capacity. But over the last 48 hours, we've seen serious disruptions. One, of course, was the Houthi bombing of the Saudi refineries. That was one, and there's been some delay in getting the Iran nuclear deal done. The reason why I talk so much about the Iran nuclear deal is simply that the Iran nuclear deal has to be revived this month if it is to have any meaning. Reviving it after 2 or 3 months, Iran would probably have enough fissile material for 3 nuclear bombs. They might even be able to store away 1 or 2 nuclear bombs worth of fissile material away from inspectors. And there are no inspectors allowed in right now because of the suspension of the JCPOA. So it would become almost meaningless to revive the nuclear deal much beyond this month. So in 2015, when the deal was originally done, all the surplus fissile material that Iran had beyond what was allowed under the JCPOA was sent away to Russia because Russia was the country that Iran trusted. And so this time again, it might be necessary to do the same. Russia had some objections. They wanted some written assurances from the US in order to revive the JCPOA. 4 or 5 days ago, the Russian foreign minister has said that they have received those assurances. Although the Americans denied it, apparently the Russians are satisfied that the assurances that they were seeking are already in the language of the revived deal. So I think the deal is very close to being done. When that is done, Iran will be able to supply an additional 1.5 million barrels per day within 2 or 3 months. You can't do it just with the snap of a finger as soon as the sanctions are removed. But within 3 months or so, so by about July, I would expect that Iran will be back to producing and exporting as much oil as they were doing prior to 2018, when the Trump administration pulled the plug on Iran. So if you see that, then we could well see 1.5 million barrels per day of additional oil supply from Iran coming through. That'll help to dampen prices. And as I pointed out last month as well, if you have crude oil prices, Brent crude above $60 a barrel for a 6-month period, you begin to see shale oil production really pick up significantly. And so we've now had 57 weeks of Brent crude above $60 a barrel already.
Right.
We've had it nearly 7 months above $75 a barrel. So we're at a point where shale oil producers in the northeastern US are looking pretty good. And they probably, the first 6 months they have probably used to help pay down some debt and so on. But they should soon be in a position, in fact, they're probably already in a position to begin to invest in new fracking facilities that will see a massive gusher of new output coming up from the US within the next 4 to 5 months. So that remains my view, that we'll see Brent crude back down to around $60 to $70 a barrel by August, September this year. And that is simply because there's going to be this additional supply from Iran, there's going to be additional supply from the shale producers, and perhaps even from the tar sands in Canada. So that will hugely boost supply and help dampen prices. Of course, there are some things like war disruptions. If the Houthis manage to hit Saudi facilities, of course, that could be a dampening factor. It could be a dampening factor in constraining the Saudi capacity to boost its own output. But I'd say within the next 4 or 5 months, we'll see a significant increase in supply, which brings prices down. And that is why I think that, to answer your previous question, RBI, in my view, a month ago, I had expected that RBI would need to raise rates more in the second half of the fiscal year because inflation would pick up then. Now I think they'll probably do the two 25 basis point rate hikes earlier in the year, probably in the May to July period, because of the higher inflation coming from crude prices and their cascading effect in the economy domestically. And then, of course, the second half of the year, lower crude prices and their positive impact will dampen inflation much more than I would have expected even a month ago.
So does that mean that earnings would be impacted for, say, next 2 quarters?
Well, I think there could be some negative impact especially in the first quarter of FY23. A lot of commodity prices have risen. So materials prices would have risen for a lot of producers. And a lot of companies in India would see a negative impact from that. And so I think, that'll have a negative impact on corporate earnings. Also, the fact that interest rates go up a little bit sooner means that too will have a negative impact. Yes.
So where do you see the equity markets heading? Because there's too much of uncertainty. Markets have been staying volatile in this entire month. We saw a low of around 16,100 for Nifty, and then we are back to 17,000 levels. So do you expect this kind of an uncertainty or volatility to continue for some more time?
Yes, I think war is a source of uncertainty and risk. So as long as we have a war having a big impact on the world economy, you're going to see for very volatile markets, and markets are they're going to be yo-yoing, which is typical of volatility. Yo-yoing with a downward bias, I'd say, in the next 3-4 months, and partly because of very high U.S. inflation, which is obliging the Fed to tighten sooner. Now, interestingly, I think it's quite interesting from an Indian standpoint that I told you that broad money supply in the US had grown exceptionally rapidly during the pandemic period, during this COVID phase. On the other hand, if you look at India, in the 28 years before the COVID pandemic, so that is 28 years ending February 2020, India's average broad money M3 growth was 15.4%. In the period since March 2020, broad money M3 growth has been 11.3%. So India has actually seen slow, and if you look at the current number, it is 8.8%. So it's even lower. So if anything, India has had no extraordinary monetary accommodation. In fact, it has had an exceptionally weak period of broad money growth, and it's also had an exceptionally weak period of bank credit growth. As a consequence, India's domestic demand, I mean, what is striking is that you have spectacular growth in exports. So let's look at steel, right? Steel exports are up about 70%. But steel output during the fiscal year to date is up much less. It's up about 12% or so. And in the latest 2 or 3 months, steel output is barely growing at all year on year. So that suggests that domestic demand, if anything, is too weak. And there really is no need for India to very aggressively tighten monetary policy, because it never loosened monetary policy that much during the pandemic period. And so, being an inflation-fighting central bank, the RBI has to keep its credibility, and that is why I expect that if you have 3 or 4 months of inflation, even marginally above 6%, which is what I expect will happen, the RBI will raise rates. But it could return to accommodative policy, generally accommodative policy, soon thereafter. And I noticed, for instance, the last 7 weeks, if you look at the RBI's net activity in the market, it has been contractionary. So they've been draining liquidity rather than adding liquidity. It's quite interesting that the Central Bank of India is draining liquidity at a time when, even in February and early part of March, the Fed was still adding to its balance sheet. So India has been draining, and I think that once the extraordinary oil price situation goes away and is better contained, there is going to be some scope for more accommodative policy from the RBI in the second half of the fiscal year.
Okay, that's going to be playing out.
I'm not saying that they're going to cut rates, but take other actions, open market operations, and so on, to facilitate a recovery in bank credit. So bank credit also needs other actions. For instance, we need to see the asset reconstruction companies make quicker progress on taking NPLs out of the banking system quicker and on a more credible basis, so that banks' balance sheets are cleaned up and they are in a better position to start a new credit cycle. For an economy of India's size, and given the fact that India is still an emerging economy, to have credit growth of less than 10%, 8.7% credit growth at the moment is exceptionally weak. India definitely needs to see a much faster pace of credit growth if a private investment-led recovery is to occur. Of course, the government has provided for a big boost to public investment in the year ahead, but that needs to be complemented with a recovery in private investment as well. So there's a lot of incentives for things like the production-linked incentives provided to a number of different sectors, which should help to stir up a rebound in investment spending. But you cannot have a broad-based recovery in private investment in the absence of a new bank credit cycle.
Thank you, Mr. Basu, for your time, for sharing your views on the macroeconomic scenario. Thank you so much.
My pleasure. Thanks. Thanks, Geeta.